Okay, perfect. Zooming into a bit, looking into question 229, starting off with receivables. Okay, first we look into question 229. What is there? So, question 229, basically, what they're asking us in simple words is we need to find the gross receivables. So what we need to find in question 229 using receivables ledger control. So, what are we doing? Find the net receivables which we get. We have to first find the net receivables here. For that, we have to find the gross receivables, and from that, we'll subtract the allowance. So that's why we'll first calculate the gross receivables, and from that, we will subtract the allowance. So you'll get the net receivables. Okay, we'll anyway do it step by step. So what are they asking us to do here? They're asking us to first find out the net receivables here, and when? On 31st December 2006. What are they telling us to find out? The net receivables, right? This is what they're eventually telling us to find. So if you see the steps over here, in the step first you have to find the gross receivables. From the gross receivables, when you subtract the allowance, you will get the net receivables. From the gross receivables, when you remove the allowance, you will get the net receivables. Okay. So this is what we will do eventually, step by step, high level. We are making the idea in our mind. They're telling us to do net receivables, and first we'll find gross. From that, we will remove the allowance. Okay. So that is about this. So now let's start making the T account step by step. So the formula here is net allowance is gross allowance minus allowance for receivables. So let me just write this out here in your notes so that when you revise it's easier. Okay, allowance is here. So you take here gross receivables minus here allowance will give you net receivables. Okay, gross receivables minus your allowance will give you net receivables. This is your question 229. Gross receivables minus allowance gives you your net receivable. Okay, so gross receivables minus allowance give you your net receivables. So here. Okay, so starting off now, we updated the formula gross receivables minus allowance is net receivables. Now let's try to solve it. So first what we'll do is we will go into the solution. As we read the case simultaneously, we'll be solving. We start with the opening balance on 1st Jan 2008. What is the opening balance? So here, as we can see, the opening balance that is they have given to us. Now this, all the numbers are given to us. Slowly, we will start the entire calculation and get a strong understanding about this. Okay. So in the statement of financial position, the Allen had a net receivable. So the opening balance of net receivables is given. Okay, net receivables opening balance they have given, right? That is 2005. When do we need to find the amount as of 2006, right? So this is the opening of that year. In the opening of that year was 12,000. Okay, 31st December of 2005. Okay, so in the question here, 31st December 2005, we have the value of 12,000. Okay, we have the opening here, receivables 229. We had the opening of 12,000. Okay, this is the first thing. Next, what they're telling us is that, and this brought forward figure, okay, on 31st December 2005, Yalin had a net receivables of 12,000. So this will be our opening on the, or you can tell this is your 1st January 2005, 2006, same amount will be there. 1st January 2006, you know the amount, it will be 12,000. Okay, 1st January 2006, you know the amount, that will be 12,000. Okay, now during the year, they made sales on credit. During the year, they made a sales. Okay. During the year, they made a sales. Okay. So during the year, what happened? During the year, what happened? Given during the year, we made the sales. How much sales did we make during the year? Yarin made a credit sales of 125,000. Okay. So during the year, so opening receivables was net receivables was 12,000. During the year, we made more credit sales. That means more receivables. More credit sales means more receivables. Okay, more credit sales means more receivables. Okay, we have more credit sales. That means we have more receivables. Okay, more credit sales means more receivables. Okay, so this will increase our receivables. If you think about this, will increase our receivables. So it is added on the side of the opening amount. Okay, this will increase our receivables further. So we have kept it on the same side. Let me just put a different color here. Okay. So what is our sales, credit sales during the year? 125,000. This is more we have sold. Now we'll have more receivables, right? Now we will have more receivables. Sales is 125,000. And received cash from credit customers 115,000. So this will reduce our receivables. Yeah. Logically, if you receive the cash, your receivables will reduce, right? You received the cash. That means now your receivables will reduce. So it will be on the opposite side. Yeah. Your receivables reduce. If you receive the cash, obviously your receivables will reduce. Okay, so how much cash did you receive? 115,150. So this will reduce your receivables. Okay, this will reduce your receivables. Okay, so till now what we've understood, we have the net receivables opening of 12,000, but here you see we have not taken as 12,000, right? We have taken 13,150, right? Because here the opening is our gross. We have to take the opening as gross and we'll get there, no worries. But here first is your net receivables is 12,000. During the year, we made more sales of 125,000. This will further increase our receivables. And we received cash from credit customers amounting to 115,500. And 115,500, we received the cash. This will further reduce our receivables. Sales will increase our receivables. Cash will reduce our receivables. Sales will increase. Cash will reduce. Sales will increase our receivables. Cash will reduce our receivables. Okay. Sales will increase our receivables. Cash will reduce our receivables. At 31st December 2006, Yanlin decided to write off the debts of 7,100. This much now we are not going to get only. This is further reducing your receivables. Because you're like, this much money we are not going to get only. So you'll remove that also from your receivables. So this again is reducing from your receivables. So this is again reducing your receivables balance. Why? Because you're not going to get it. So anything that reduces the opening goes on the opposite side. Opening will come here. Anything that reduces the opening comes here. Okay. Anything that reduces the opening comes here. Okay. And next they're telling and increase the allowance of receivables by 950 to 2,100. Right? What they want to do, they want to increase the allowance. What do they want to do? They want to increase the allowance. Okay, what do they want to do? They want to increase the allowance. This is the final thing that they want to do. They want to increase the allowance from 950 to 2,100. Okay, how much they want to increase it by from 900 to 2,100. This is what they increase by 950, right? Not from 950, right? You see this by word is very important. So what is it currently, right? If adding something makes a number 2,100, what is that number? If adding something to a number makes it 2,100, what is that number? Yeah, let's calculate that. रणबीर कितना होगा? क्या चीज में हमको 950 ऐड करने से how much should we add to a number? When we add 950 to a number, it becomes 2,100. What is that number? Yeah, absolutely. 1,150. So our gross receivable is 13,150. Our gross receivables is 13,150 because our net receivables they have given 12,000. And how do you calculate? We have just seen the formula here. I've written down the formula in your Excel also. Your gross minus your allowance becomes your net. So you have the net and you have the allowance. You will get the gross. Okay, once again. How much should, if you increase by 950, if you increase your allowance by 950, it becomes 2,100. If you increase your allowance by 950, it becomes 2,100. What was your allowance in the first place? So it was 1,150. Net receivables, they have already given 12,000. I want to find gross receivables. So I will add the allowance because what is the formula? Gross minus the allowance is equal to net. Net is given, gross is given, net is given, allowance is given. I will add it to the gross. So I'll get my gross amount. So the gross amount is 13,150. This is my gross. On this, during the year, I made further sales. This is increasing my receivables. If I sell credit sales, increase my receivables. But I've got some cash, reduces my receivables. Irrecoverable debt, reduce my receivables. Okay. Irrecoverable debts also reducing my receivables. Okay. Irrecoverable debts are also reducing my receivables. What are irrecoverable debts doing? They are reducing my receivables. Okay. So this is how we've got from the what we have got the opening, we have got the sales. Okay. And then we add everything up, right? Then we add everything up. What do they want to know? Give me the when we add everything up and we get the amount. This is a final answer of gross. This is my gross receivables at the end of the year. This is my gross receivables at the end of the year. Yeah, this is my gross receivables at the end of the year. Easy. How? These two I'll add. These two I add. Then whichever size is highest, right? This side will be the highest 138. Here also 138. The balancing figure I'll get 15,500. So automatically this is my gross receivable. But in the question now they're asking gross. No, but they've given the option of gross. Yes, they can trick you here. But they want net receivables. How do you do? You subtract the allowance. Allowance already they've given. 2,100 is the new allowance. So you subtract the new allowance and you will get your net receivables. That's it. And you'll get your net receivables. Okay. And you're getting your net receivables. Okay. To get the net receivables, you make a gross receivable account and you get the closing gross. And last May, you just remove the allowance from the closing gross. You will get your closing net. Okay. You just get the closing net. Easy. Okay. Anyone, any question on this? Anyone who want to repeat this again? Anyone who missed any step? Well, you just get the first sum, everything will flow. If you get stuck here, then you will just feel like uphill battle. Anyone wants me to repeat? You got stuck anywhere? Yeah. Jaswanti, did we understand this? Is it clear?
Yes, sir.
Okay. Yeah. Ranveer, is it clear, buddy?
Yeah.
Okay. Let's do one more now. Similar. Let's do one more. This 229. Okay. Now let's look into 230. What about 230? Yeah. Okay. Let's look into 230. What does 230 have in store for us? Okay. Now receivable on 1st Jan 2008. Yeah. Receivable on 1st Jan. So first of all, what do they want us to find? Right? What do they want us to find? First, always figure out what do they want us. They want us to find the revenue. Right? So what is total revenue? Cash revenue plus what? First of all, what do they want us to find? They want us to find the revenue. Okay. What do they want us to find? Revenue. And how do you get revenue? Total revenue, cash revenue plus credit sales plus cash sales. Right? How do you get total revenue? Credit sales plus cash sales. Okay. Cash sales are given. You have to just find the credit sales. Okay. If you see here, cash sales is given in the question. Okay. In the question, if you see, cash sales is already given. Okay. And even if you see in the answer, cash sales is already taken away here. Okay. You have to just find the credit sales. Right. Same T account we had done in the previous sum. You see credit sales we had got here. So here we'll have everything else and except credit sales. So we'll get the credit sales using this T and then we'll add the 2 and we'll get our answer. Okay. So first you have created an outline in your mind. This should come to your mind first. As you solve this sum, okay, aise karna hai. Then you go through the numbers. If you don't get that outline, then again we have not practiced well. That outline should come in your mind. First, always look at the sum from an outline perspective. Okay, outline how to do it. Then you get into the specifics. So if they tell you to find out revenue, what you have to do? What is revenue? Cash plus credit. Cash is given, so you just need credit. How do you get the credit? You just make that T account we had just made in the previous sum. Once again, we'll make it. It will be super clear to you. Okay, so what is revenue? Revenue is all the sales. So credit sales plus cash sales. So first of all, use your credit. We'll use a receivables account to find the credit sales. We'll use receivables to find the credit sales. Okay, what we'll do? We'll use receivables to find the credit sales. So let's use receivables to find the credit sales. Okay, so we'll go quickly now. Well, we've done the previous sum. We've given more time. Let's just speeden up a little bit on this. So guys, opening is given. So here see receivables opening is given. So I've taken the opening over here. Okay, opening is given. Opening is given. Okay, so opening, like just like the last time, there's this gross opening. Okay, then closing is given. Okay, opening and closing, first I'll make the adjustment. Opening and closing both we have taken. Opening and closing. Here also opening and closing both we have taken. Okay, easy ones. Let's first do the opening closing. It's always the easiest thing to do. Opening closing. Okay, then cash received. Any cash received, guys, reduces my receivables. If I receive the cash, it's reducing my receivables. Right? Some people who I buy and sell with them, I'm contra with the payables. That means same person, I have to buy also I buy from him also, I sell from him also. So instead of paying cash, I net it off. Instead of paying cash, I have to buy something from him also, I sell him something also. So I have both the relationship with him. So we keep doing contra, right? We keep netting it off, right? We keep netting. So both are reducing your receivables. Okay, both are receiving. So whatever money you got, that is also reducing your receivables. Cash received is also reducing your receivables. Any contra means a party with whom you buy also, you sell also. So you never pay them full cash. You always settle on net basis. So you have to receive from them certain amount, but then they have to pay you thousand. You have to pay them 1,200, and you have to receive from them also some amount of money. So you remove off, you net it off. What you do, you net it off. You won't pay them from cash. You will pay on the net basis. So whatever amount is there, you net it off. That is the contra. Both are reducing your receivables. So they are on the opposite side of opening. Because they are reducing your receivables, they are on the opposite side of opening. They are reducing your receivables, so they are on the opposite side of opening. Okay, they are reducing your receivables, so they are on the opposite side of opening. Then there are some irrecoverable debts. Right? This is also reducing your opening receivable balance because you're never gonna get this now. Yeah, you're never gonna get this really. Yeah, you're not really gonna get this. This is also removing your. Okay. So you took all this and you got your credit sales. Okay, you netted all this and you got your credit sales. Obviously, two extra information is given, right? And by doing this sum, you have understood what the extra information could be in this case, right? In this case, what the extra information can be. When you find the allowance when there are net and gross, that time. Okay. Discount received, you net it off. You don't record it separately. You net it off from the sales, from the purchases. Discount received will be again in purchases. It's something related to your purchases, not your receivables. In receivables, you give discounts. You don't get discounts. Okay, so these are the extra. So as you do the sums, you start picking up what you need. So automatically you will recognize the extra. So you add the cash and the credit, you get the total. Credit you found out over here, balancing figure. You balanced everything. You got the balancing figure. This is the balancing figure. Okay, this is your balancing figure. Okay, you got your balancing figure. Once you got your balancing figure, that is your credit sales added to the cash sales. That is your credit sales, just added to the cash sales. Okay, that's the credit sales, just added to the cash sales. That's it. That's the credit sales added to the cash sales. Okay. Yeah. Let's quickly go through this here. Where were we? How have we gone about this sum? Credit sale कैसे निकला?
When we netted off the cash received and the contra and the irrecoverable debts, then we got the credit sales.
Okay. फिर आने के बाद क्या क्या credit sales को?
We had taken we balanced it.
ठीक है. And we added it to cash sales and we got the total sales. That's it.
Yeah.
Okay. That's it. Yeah. भव्या clear है ये वाला sum कैसे हुआ? स्नेहा clear है ये? Okay. स्नेहा समझ में आया ये कैसे किया हम लोग स्टेप बाय स्टेप? स्नेहा आवाज आ रही है मेरी? Okay. That is about this. Vaibhavi, is Sneha on the call?
Yes, sir.
Okay. स्नेहा आवाज आ रही है मेरी अब?
She has texted in the chat box.
Okay, okay, done. Great. क्या है text? She understood what has she replied?
Yes, sir. She said yes.
ठीक है. Okay. So 1, 2 sums, guys. If you get the hang of it, After that, it will start feeling easy. बस एक दो sum में थोड़ा सा लगता है, and after that, it is very straightforward. Okay, let's look into the next one here. The following account has been extracted from the general ledger. Okay, so we have an account already. There, after amendment, what is the correct receivable balance carried forward? So they want the closing receivables. So now you know this time what you have to calculate. Okay, what do you have to calculate? Closing receivables. What do you have to calculate? Closing receivables. Easy. What do you have to calculate? Closing receivables. Okay. What do you have to find out? Closing receivables. Closing receivables you have to find out. Easy. Okay, so you know exactly now you can visualize what you have to calculate. Okay, you can start visualizing what you have to calculate. Okay, so you know this you have to calculate. ये आंसर आना है अभी एक आउटलाइन बनना चाहिए दिमाग में कि क्या आ रहा है. Closing receivables means exactly what that this picture should come in your mind. This number you have to calculate. Okay. So they gave you a wrong T account and told you there are some things will be wrong. You have to figure out what are the wrong, and then you have to make a new account and then you have to get the answer. Okay. So let's look into it. We'll go a little fast on this because it's a similar sum. Okay. So first you have your opening. You have your opening. Easy. Opening, no problem here. Okay. Opening and opening, no problem here. Okay. Opening and opening. Done. Then contra with payables, right? Contra with payables come on that side. This is the first mistake. Right, contra with payables we had just done in the previous sum. Whenever you have purchase and sales with someone, instead of paying in cash, you net it off because you're purchasing also selling also. You only settle on net basis. Okay, so this is the first mistake. This comes over here. And discount received, we had saw in the previous sum that discount received is something comes in purchases, not in receivables. It will affect your something that would be your affecting your payables, right? It will not affect your the not relevant to receivables. So that is why this will not be a case. Okay. So that is done. These two we have adjusted. Credit sales 644000. So credit sale will keep it as it is here. Credit sale stays. Credit sale says we had just done the previous sum. We had calculated this. Now we are using this here. Irrecoverable debts as it is, no problem. Right? These are all no problems. Then cash received 625. Okay. Allowance is not something that we take in the receivables account separately. It's just used to convert gross to net, net to gross. Right? We do not directly use it. Right. Allowance, we do not use this particular receivables account. Okay. So we found रिसीवेबल अकाउंट में हम लोग नहीं यूज करते हैं इनको द डबल एंट्री जैसे यहाँ पे दिया हुआ है दैट द इंक्रीज इन अलाउंस फॉर रिसीवेबल्स इसका डबल एंट्री में इररिकवरेबल डेट्स एक्सपेंस अकाउंट टू अलाउंस अकाउंट तो ये बस एक दूसरे अकाउंट में जाता है जो अलाउंस है ओके वो एक दूसरे दैट गो सॉरी इट गोज इन अ डिफरेंट अकाउंट ओके and that is the reason why we don't use it here. Okay, it goes in a different account, and to be more precise on that, there are दो accounts होता है एक अपना one is the general receivable ledger account that we are making right now. So here we see how much the customer actually owes us. So there are two accounts that we make generally. One is a receivable ledger account and one is allowance for receivables. So these are generally two separate accounts. So receivable ledger account, we just see how actual money that the customer owes us. It just gives us the overall clarity. Now coming to allowance, right? This is basically our guess that some money will not be paid. Our guess that some money will not be paid. That is called as an allowance, right? So we keep them in two separate accounts. In receivable ledger, we just track each customer, their cash, their sales. We write off all that happens here. We just keep it in receivables. But allowance is just an estimate. It's not a reality, right? It changes every year based on risk. Okay. Allowance is just an estimate. It changes every year based on risk. So it shouldn't affect one specific customer. Allowance is a total amount of all the customers inclusive. So we do not include it in receivables because it's an estimate. It's not the reality, right? So whenever there's an estimate for his allowance, we keep a separate account that is allowance for receivables. That account is credited. ओके, तो जब भी अलाउंस की बात आती है वो एक एस्टिमेट है, तो उसको हम रिसीवेबल्स के साथ मिक्सअप नहीं करते. वी कीप रिसीवेबल्स सेपरेट, वी कीप अलाउंस सेपरेट. We don't keep a mix of receivables and allowance, and because we don't keep a mix, that is the reason why it doesn't come here. Okay, so that is about 231. Moving on now, 232. Let's get a clear answer what is really happening here. Okay. So looking into 232 here, let's get a strong understanding what is in question 232. First one, new well co's receivable account. Okay, first of all, what do we have to find? What is the charge to P&L? They're asking us what is the amount that goes to P&L. Okay, they're asking us what is the charge that goes to P&L. Okay, we got the charge to P&L. Okay, we got the charge to P&L. Okay, okay, the charge that goes to P&L. Charge that goes to P&L. So that is what we have to calculate. What is the charge that goes to P&L? So what expense goes for P&L for receivables this year? So what is the so what goes here, guys? Outline. I'll give you two things that go here. One is how much you write off. Okay, and how much is the change in your receivables? Two things that goes. So one is how much you write off, that goes to P&L. Second, how much is the increase or decrease in your allowance. So receivables context, there are two amounts that goes to P&L. Whenever we talk about receivables, जब भी हम receivables की बात करें, whenever we talk about receivables, there are two amounts that goes to P&L. One is how much was irrecoverable. Second is how much was the decrease. One is how much was the irrecoverable. Second was how much was the decrease. These two things. How much was the irrecoverable? How much was the decrease? Okay. How much was the irrecoverable and how much was the decrease? These two amounts goes to P&L. So we have to find out these two amounts in the first place. Okay, so now you have an outline that what are we really looking to find. Then the process is what we will see. But this is the start, this is the end. So if you know the end, then you can focus well on the process, right? If we know the start, we know where we are starting, and eventually we know the end. Okay, this is the end. Then we can make sense of the process. So first we need to know the end. So what are the two amounts that goes to P&L with respect to receivables? Is number one irrecoverable debts. Number one irrecoverable debts. So that is directly given in the question. Right? They have one directly given irrecoverable debts, so they are writing it off. One irrecoverable debts. Second, any change in allowance, right? Any change in allowance. Okay, any change in allowance. Okay, any change in allowance. So how much is the allowance? Okay, so the closing allowance is five. Allowance for receiver at the previous year end. Opening allowances is 5650. Okay, opening allowance is 5650. Okay, opening allowance is 5650. What is the opening allowance? 5650. That is our opening allowance. Okay, what is our opening allowance? 5650. So we have the opening. We'll find the closing. Okay, we'll find the closing. We have the opening. We'll find the closing. Okay, we have the opening. We will find the closing. Okay, we have the opening. We will find the closing. And then once we find the difference, we will know how much is increased or decreased. If it is increased, we will add it to the irrecoverable debt. If it decreased, we will subtract it from the irrecoverable debt. What has happened to an allowance? Has our allowance gone up or has our allowance gone down? Has our allowance gone up or has our allowance gone down? That are the two expenses. Okay. Now moving on now here in a little detail. So new Velco decides to write off. So write off is here. 8,900 is the write off. Write off is here. Next, we have to find the receivable. So we'll look into this now. So we'll start here. Newell's core receivables account show a balance of 58,200. So we have the opening balance 58,200. Okay, we have the opening balance easy. Okay, receivables we have the opening balance 58,200. Okay, before the following adjustments is made. Opening is there. Now we are making adjustments. What are the adjustments? First of all, Newell decides to write off a debt because they think it's irrecoverable. They're totally writing off the debt. Sorry, irrecoverable debt. Some is irrecoverable, so they're totally removing it. They're totally removing it. Some they are totally removing. So this is the first expense. So after that, we have 49,500. That is the first adjustment done. Second, they decide to make an allowance for Carol's debt of 1350. So they are making some allowance. For Carol debt, they are making an allowance of 1350. These are all the allowances that they are making. Right? These are all the allowances. For Carol's debt, how much allowance? 1350. For J, how much allowance they are making? 750. For my, how much allowance they are making? 1416. This is the total allowance they are making. For Carol, how much? For J, how much? For my, how much? So these are the three allowances they are making. For Carol, for J, for my. These are the three allowances they are making. For Carol, for J, and for my. These are the three allowances that they are making. Carol, J, and my. These are the three allowances for Carol, for J, and for my. Total allowance, when you add everything up, right? When you add everything up, the three allowances, you get a carried forward of your allowance of 3516. This is what the carried forward allowance. Okay. 3516. Adding up all the allowance, you're getting 3516. This is the allowance of this year. Okay. And now the balance brought forward. The closing allowance you got, opening allowances was already given in the question. Okay. Opening allowance was already given. So if you see opening and closing, the total allowance that is needed this year, they need only 3156. Opening was 5650. The extra that they can decrease right now, a decrease in their allowance. If you see here, there's a decrease in the allowance 2134. So their expense is coming down. So 8900 minus the decrease of their allowance. This is the total expense of allowance. This is the total expense of allowance. Okay, this is the total expense of allowance that will go to P&L. So what goes to P&L? Number one, irrecoverable debts, easily directly given in first point, no problem. Second, how much allowance this year? They've added everything, that much allowance this year. What do they do with this? They compare it to the allowance. These are the three allowances this year. Then what do? We compare it with the opening allowance. Then what do? We compare it with the opening allowance. Closing allowance 3516, opening allowance 5650. The difference between the two allowances 2134. It's a decrease. So it's a decrease in expense. Allowance is an expense. So our expense is decreasing over here. So 8900 is an expense and a decrease in expense of 2134. The total expense this year 6766. Total expense this year 6766. Total expense this year 6766. Okay, what is our total expense this year? 6766. Okay, what is our total expense this year? 6766. Okay. What is the total expense? 6766. Okay. What is the total expense? 6766. This is the expense that goes to P&L. Yeah, let's make sense of this here, Ranbir. What are the two expenses that would ideally go from receivables to P&L? Yeah, Ranbir, can you hear me, buddy? ओके राइट भव्या, कौन से दो खर्चे हैं जो जाते हैं P&L में रिसीवेबल से?
हेलो।
हाँ भव्या, ये तो मैंने हाईलाइट करा है, कौन से दो खर्चे हैं जो P&L में जाते हैं?
इरेकवरेबल डेट।
वेरी गुड। और?
हेलो।
हाँ भव्या, और कौन सा?
इरेकवरेबल डेट्स एंड अलाउंसेस।
अलाउंसेस, वेरी गुड। तो यहाँ पे अलाउंस में इस साल अलाउंस कम हुआ है या अलाउंस ज्यादा हुआ है अपना? Decrease हुआ है, and that's why we are taking the 8900 minus the decrease. Perfect, thank you. That is about this. Yeah, Vaibhavi, did we make sense of this? Is it clear?
Yes, sir.
Okay, Jaswanti, positive on this? Is it clear to you?
Yes, sir.
Okay, Sneha, clear to you this one? Okay, that is about this. Okay, Vaibhavi, has Sneha replied?
No, sir.
ठीक है, चलो check this out later. Okay, let's get started now. Next sum 233. Again, just spending some time here because once you get the hang of it, these sums just look big. They are very easy. So just don't feel bogged down by looking at the length of the sum. You just break it down. It's the same process again and again and again. Let's look into the next sum here. Find the gross receivables, allowance, and net receivables. What are we doing? First, we are finding the gross receivables, then we're finding the allowance and net receivables. So what and all we have to find out? Three things. final amount of the receivables, the allowance, and the net balance. We have to find all of them. So let's look into this line by line. And 31st June, an allowance for receivables was 48. Right? Initially our allowance for receivables was 48,000. Okay, on 1st July. Okay, on 1st July. Okay, on 1st July the allowance was 48,000. On 1st July the allowance was 48,000. Okay, on 1st July the allowance was 48,000. Okay, on 1st July the allowance was 48,000. Okay, 1st July ko the allowance was 48,000. Easy. 1st July the allowance was 48,000. This is on 1st July. At 30th June, that is the end of the year, the receivables was 838. End of the year, the receivables were 838. Okay. It was decided to write off 72,000. Okay. It was decided that you'll write off 72,000. Right. This will be written off. So this will be our receivables. After writing it off, जो भी बचता है, after whatever is written off, this will be my receivable balance. So receivable is done over here. Okay. So it's from whatever we have to write off, it's no longer going to be part of the receivables because we are writing it off. It's no longer going to be part of this. This will be my receivables. Just subtract this here. How much are we getting here? Vaibhavi, subtract करो कितना आ रहा है?
Sir, so 80, this क्या करना है, like 888,000 से करना है 72,000 को ना?
Correct.
या फिर हाँ मतलब
कितना है?
766,000.
Okay, so our answer has to be between B and C. Okay, now reading it further. Of these, so we've got trade receivables. How to calculate trade receivables? We take the receivables, whatever is written off, we net off that. So we got the receivables after subtracting the write-off. You're writing off receivables because you're no longer going to pay. So you're going to write it off because you have to show it at a realizable amount. You're not going to show it at the actual amount. Receivable should always be at a realizable amount. So from 838, you've subtracted the 72, you've got your 766 of these debts. Okay. And adjust the specific allowance for receivables to 60,000. So what you're doing is now you're getting the receivables to, not by, to 60,000. So now your receivables will be 60,000. Right? If you see in the previous sum, they have told when you increase by, when you increase something by, that means that is the value of the increase. So we have done in the first sum increase by 950. Right? But here they're telling increase it to 60,000. So now your receivables will be 60,000 because you have increased it to 60,000. Right? This buy into is something that you have to just be a little mindful about. You have to increase it to 60,000. So now your receivables, new receivables will be 62,000. Sorry, it's 60,000. From 48, it becomes 60,000. Okay. So your net balance from 70, say 766, you remove 60. So your net receivables. Okay. Your net receivables. Right. When from gross you remove your net allowance, you will get your net. We had just written this formula some time ago. Right. Your net allowance is 706. Your net allowance is 706. Okay, sorry, net receivables. Gross receivables 766, allowance 60, net receivables 706. 766, 706, and 60. We had done this some first sum we had done, right? That how to get net. You see, this is the first sum we had done. How to get the net. From gross, how to get net, we subtract the allowance. So here also from gross, we have subtracted the allowance, we have got the net. From gross, we have subtracted the net, we have got the, from gross, we have removed the allowance, we have got the net. From gross, remove the allowance, you will get the net. That's it. Same thing has happened over here. Okay, now I think we can speed up. Let's go. Next one. We're looking at the irrecoverable debt expense now. Irrecoverable debt. Now we have what we have to find? We have to find the irrecoverable debt. Okay, so let's find the irrecoverable debt. What is the irrecoverable debt in the year? Okay, so let's look into the irrecoverable debt expense. Okay, so let's make sense of the irrecoverable debt expense. What about the irrecoverable debt expense? Okay, so let's break it down here. When we look into the irrecoverable debt expense, in the year ended 30th September 2008, Gulzar had sales of 7 million. Okay, so how much was the sales of Gulzar? Right, sales of 7 million. and the year-end receivable was 5% of annual sales. So how much receivables he had? First of all, how much were the receivables? He sold for 7 million. Okay, first thing, how much was his sales? 7 million. In this sales, how much percent was receivables? 5% were credit was receivables. Okay, credit sales of 5%. 5% was his receivables. Okay, so total receivables was 350. Easy, right? 350. So this, from this we have got our total receivables. From this much part we have understood what were the total receivables, right? This has given us our total receivables. Easy. Now they are telling this is our gross receivables. From the gross receivables, how much? What were the allowance amount? What were the amount of allowance? They have made some allowance also. The allowance was 4% of the receivables. So we got the total receivables, and of 4% of those receivables is my allowance. Right? 4% of those receivables is my allowance. Given in the question, 4% of the receivables, 4% of the receivables amount that we had taken is my allowance. 4% of the receivables is my allowance. So I got the allowance also. Okay. And they're telling it was 20% higher than at the previous year end. So this year allowance was 14,000, which was 120. What does that mean? It was 14,000, which was 120. Which was 14,000, it was 120. Pentapla. Okay.
You keep it in the
Surprise. Okay, so that was about. So if 100, so you can just do it in the simple way. Right? Okay. नहीं है. Okay, that's what यहाँ पर इसमें 100, 120, 100, 120, 100 has become, it's 20% above. So previous year, we don't know the amount, but this year, the amount is 14,000. Okay. So what will this be? Okay. What will this be? So previous year, let's assume if something was 100 and if you increase it by 20%, it will become 120. Similarly, if something's 120 is 14,000, what will be the 100? Okay. What will be its 100? Okay. If something's is 120, what will be its 100? Just look into at what will be its 100. Okay. You do 120 into x, 14,000 into 100 by 120 into x. You cross multiply. So when you cross multiply, you will get 100 into 14,000 is equal to 120 into x, which is your answer, into x. Okay. So you do 100 into 14,000 divided by 120. Leave the x at it as it is. Right? This entire thing divided by 120. Okay, let's do this, Vaibhavi. कितना आ रहा है देखो.
$11,660.
67, right? So this is
67, yeah.
So this is your opening allowance, and you got your closing allowance. So how much is the increase in your allowance during the year? How much has your allowance increased by? 233 is the increase in your allowance. Okay. Now you make the irrecoverable debts T account. That's it. Now we'll just make the irrecoverable debts. So they're saying during the year, irrecoverable debts amounted to 3,200 were written off. So your irrecoverable debts written off was 3,200, and the debts amounting to 450 and previously written off were recovered. So how much was recovered? 450 was recovered. Okay. 450 was recovered. Okay. How much was recovered? 450 was recovered. And we note the increase in the allowance. Right? Increase in the allowance we have just calculated 2,333. So a balancing figure is the answer of this question. That the statement of profit and loss, we will get the expense that this year how much was the expense that goes with regards to irrecoverable debt. Okay, so we have the write-off of irrecoverable debts, the irrecoverable debt expense. We make the T account of irrecoverable debt expense. We make the T account of irrecoverable debt expense. Okay, irrecoverable debt expense. We made the T account. In that, what was written off? 3,200 was written off. And what was the increase in the allowance this year? 2,333 is the increase in allowance versus what was recovered. What was recovered will obviously be on the other side. It was recovered, money came in, so it went 450. So you got the balancing figure, you understood what goes into P&L. Okay, so again, we just do a couple of sums like that, you'll get the hang of it. One was the receivables account, you did three sums, you got the idea. Now we are looking into another sum. Okay, I think 235 is very straightforward, guys. I think, we have done enough of this sum now. So we can just quickly try this. Just literally, we can do it verbally only. So you see, on 1st January, the trade receivables were 10,000. Okay, so opening was 10,000. Also, what we have to find is the closing. Opening they have given us. This is the closing that we are looking to find. Okay, what are we looking to find? We are looking to find this closing. Right? This we have to find. Okay, this we have to find. The closing is what we have to find. Opening they have given us. Opening 10,000 they have given. I've written 10,000. Okay. Then credit sales during the year 100,000. Credit sales 100,000. Next, cash received 90,000. We received 90,000. That comes over here just like the previous sum we had done. And contra with payables, I have netted it off with payables 800. Discount received. Right. This is something that doesn't come generally because it's related to payables, not receivables. Next, cash received 100. Irrecoverable. Previously, I had written off it. Money came now. Right. Irrecoverable debts recovered. Right. This is a new item that we have studied. That irrecoverable debts used to come that side. Automatically, irrecoverable debts recovered will come this side. If the irrecoverable debts in the previous sums we saw, irrecoverable debts had come here. You see here, 4,300 irrecoverable debts. You see here, 18,600 irrecoverable debts. If irrecoverable debts is on that side, automatically irrecoverable debts recovered will be on this side. Right? Something that you've recovered this year. Irrecoverable debts recovered will come here. Okay. And then you got your balance carried forward. You got your balance carried forward. Okay. You just remember that your irrecoverable debts, it used to reduce your receivables, goes the other side. But whenever there's a recovery, you put it on the side of the balancing figure. Whenever there's a recovery, because you had written it off anyway, it was gone. Before only it was gone. So just to close that written off on the opposite side, because it was recovered, on the opposite side, you're putting an entry. Right? So you're reducing your irrecoverable debts account basically. What are you reducing? You're reducing your irrecoverable debts account. Irrecoverable debts account was always on the other side. So now you're reducing that because you've recovered the money. So it comes over here. Okay, it's literally straightforward here. And after doing everything, we got the balance carried forward. We got the balance carried forward. Okay, we got the balance carried forward. Okay, that is about this. We got a balance carried forward. 235, we got a balance carried forward. Okay, let's do the next one here. What do they want? Which of the following is the double entry? Okay, what is the following is the double entry? So let's look at the double entry. What is the double entry over here? Okay, what is the double entry here? So firstly, we'll look into the double entry. GCO has notified a customer has been declared bankrupt. Now no money is coming from him. He's declared bankrupt. Okay, and the GCO had previously made allowance for this receivable also. And GCO, what they had done previously, they had made an allowance also for this receivable. Previously, what they had done, they had made an allowance for this receivable. Okay. Previously, what they had done, they had made an allowance for this receivable. Okay. They declared him bankrupt and they had made a receivable for the allowance as well. What they had done, they have made a receivable for the allowance as well. They have declared them bankrupt and they have made a receivable for the allowance as well. Okay. Okay. Now, which of the following is the correct journal entry? Okay. Which of the following is a correct journal entry? If we look here, correct Gundan? Yeah, correct journal entry. So we'll look here. So when a debt is written off as irrecoverable, right? If something is irrecoverable, so we record it as an expense, right? This is an expense, irrecoverable debt. Okay, it is an expense. So an irrecoverable debt account. It is an expense for us because expense AED assets and expenses are debited. So irrecoverable debts account as an expense we record it debit, and we reduce our receivables now. Right? We reduce our receivables. How much our receivables were there, we are reducing it. Right? How much ever receivables were there, we are reducing it. Right? Before we had already made the allowance, so that would have previously reduced a receivable. Now, how much ever reduced receivable is there, that also we are writing it off. How much ever reduced receivables is also there, we are writing that off as well. And any changes in allowance to receivables, that goes in a separate account. As you all know, allowances have their own separate account. So here what has happened is irrecoverable debts account. Now it's an expense and we are crediting the receivables. Debiting irrecoverable debt account and we are crediting the receivables. Okay, debiting the irrecoverable debt account and we are crediting the receivables. Okay, we're debiting this as an expense and we're reducing the asset. Asset, receivable is an asset, AED, assets and expenses are debited, but here we're crediting it because we're reducing it. Okay, let's make sense of the journal entry here. Ranveer, did we understand this, buddy? 236. Okay, let's make sense of this one here. Jaswanti, just take us through our understanding of the correct answer here for 236.
The irrecoverable debt account is an expense.
Very good.
So it's debited and the receivable asset is decreased by.
Perfect. Okay, we're decreasing an asset. Asset has a debit account. When we're decreasing it, we take it to the credit side. That's all it is. Okay, that is about this. All right, so